Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and we thought we'd come to you with a brief update on the markets, kind of let you know what's going on. The S&P 500 is currently sitting right at about 4,200, which is about the level that it sat at since the middle of April. So I sound a little bit like a broken record. It's been about 6 weeks that we've been kind of bouncing around this 4,200 range. And a decent amount of that is just driven by the fact that we've gotten first quarter earnings numbers. Earnings really moved equities, and now the market is primarily focused on this question of inflation. And a question of exactly how long the Federal Reserve is going to let this party continue before they start to either taper down their asset purchases and or more directly raise rates. And that is really the question that I think has been gripping the market for the past couple of months is, what is the Fed going to do and how long will they let this party continue? We certainly saw in April an inflation read that was at 4.2%. That is the highest that it has been since 2008. We're seeing a lot of anecdotal evidence of inflation in a whole lot of areas. So, for example, I, for one, will be making a trip to Boston later this year and will be renting a car. And I think I'm paying about $1,000 to rent a Toyota Camry for 4 days, which is obviously a lot more than I would have paid a couple of months ago. A lot of this inflation is really a result of the economy starting again and consumers going from almost zero demand to almost demand levels in excess of pre-pandemic levels kind of overnight. So, we've vaccinated a significant portion of our population. A lot of economies are reopening. Consumers are ready to get out and spend. They call it revenge spending, right? I didn't get to go anywhere or do anything for so long that now I feel like I'm going to take all the trips and do all the things. And companies just aren't ready to handle that level of demand change in such a short period of time. It's actually funny. There was in the news recently, there was news around a shortage of ketchup, which is not because people are just eating a lot more ketchup. It's because restaurants are reopening and they need to restock their supplies. And our supply chains just aren't used to that type of change. So similarly, a lot of this inflation that we're seeing in the market is no doubt transitory. It will not be here longer term. If you think about the laws of supply and demand, just think about the rental car example from earlier in this update. A Toyota Camry costs about $25,000 to purchase, and it can probably be rented for, a couple of years before it needs to be sold and they need to buy a new car. There is absolutely no reason why the rental rate on something like that should be $250 a day. If it maintains at $250 a day, the rental companies will just go out and buy more vehicles to meet that demand until there isn't enough demand to justify that rental rate. In the same way, ketchup prices aren't going to skyrocket. And if they do go up a little bit because people want demand, they will slow back down as the restaurants get full of the stuff again. The question for the Fed really is how much of the inflation that we're seeing is transitory. And there's no question, at least in my mind, that a lot of it, but there's probably some amount of inflation in that 4.2% number that's really more longer term and here to stay. And that's the big debate that's going on in the Federal Reserve as to, transitory inflation is okay. Actually, raising interest rates is not going to stop that type of transitory inflation. Since that inflation is really just being driven by people being let out of their houses and able to, eat and fly and do all the things that they want to go do. So raising interest rates isn't really going to change that all that much. They do want to make sure that they try and stay ahead a little bit of more permanent inflation in the economy. And so that's what the market's been wrestling with, which is why you've been seeing us kind of bounce around 4,200 for the past couple of weeks. In any event, if you have any questions on this or really anything, please feel free to reach out to your financial advisor or myself. I hope you have a great week, and I look forward to talking to you again soon.
Are you enjoying this content? Please subscribe to our YouTube channel or follow us at RFG Advisory on Facebook, LinkedIn, and Twitter. Thanks.